At the end of the last video, I left you with a question. If yield on stablecoins gets restricted, if earnings returns directly on digital cash becomes harder, if regulators succeed in keeping stablecoins boring, where does the yield go instead? Because here's the important thing. Yield doesn't disappear. Demand for yield doesn't vanish because a regulator writes a rule. Capital doesn't suddenly become patient or passive. Money looks for return, always. And when one route is fenced in, it quietly finds another. And that's exactly what's happening right now. But unless you know where to look, you'd miss it completely. Because this isn't playing out in meme coins, narratives, or hype cycles. It's happening in the background, in infrastructure, in places that look dull until you realise what they represent. Before we go any further, if you're new here, welcome. My name's Paula, and on this channel we talk about crypto and markets in a grounded, realistic way. No hype, no price predictions, and no pretending this space is simple. We focus on why things are happening, not just reacting after the fact. And just like in part one, a quick reminder. If you appreciate this slower, deeper style of discussion, I co-host a weekly show called the UK Crypto Podcast with Milkshake Matty, where we unpack these shifts in a much more conversational format. I'll link the latest episode at the end of this video as well. Now, let's answer the question properly, because the workaround is already here, and it's called tokenised treasuries. When most people hear that phrase, their eyes glaze over. US Treasuries doesn't sound exciting, tokenization sounds technical, put them both together, it feels boring. Which is exactly why it's flown under the radar. But tokenized treasuries are one of the most important developments in crypto right now. Not because they're flashy, but because they solve the exact problem regulators are trying to contain. Let's break this down slowly. In part one, we talked about why yield-bearing stablecoins make policymakers uncomfortable. They behave like bank deposits without banks, money market funds without gates, global saving products without borders. That threatens bank funding, monetary policy transmission, and crucially, how governments distribute their own debt. So regulators respond by trying to keep stablecoins framed as payments, not investments. But here's the catch. Governments don't actually have a problem with people earning yield. They just want to know where it's happening, to regulate who offers it, and to make sure it doesn't undermine the system, which is where tokenised treasuries come in. Because tokenised treasuries don't challenge government funding, they reinforce it. A tokenised treasury is, at its core, still government debt. It's a short-term US Treasury bill, one of the safest, most liquid instruments in the global financial system, just represented on a blockchain instead of inside a traditional broker account. Nothing radical about that. What's new is access and plumbing. Instead of opening a brokerage account, dealing with settlement delays, navigating minimums and paperwork, you can access treasury exposure on-chain near instantly in smaller denominations, often alongside other digital assets. And critically, it pays yield. So while regulators are busy arguing about whether stablecoins should be allowed to earn interest, the market quietly routes yield demand into a structure that regulators are far more comfortable with. This is the key insight. Tokenised treasuries do what yield-bearing stablecoins do without being stablecoins. They give investors dollar stability, sovereign-backed yield, on-chain liquidity. But they do it in a way that keeps debt demand intact, stays within regulated frameworks, and doesn't bypass the government's funding mechanism. From a policymaker's perspective, that's not a threat, it's acceptable. And that's why this sector has been growing steadily, without drama, without hype, and without backlash. Now zoom out for a moment. This is where the crypto conversation changes. Because if yield migrates from stablecoins into tokenised treasuries, then crypto stops being an alternative financial system and starts becoming a new settlement layer for the existing one. That's a massive shift. Instead of fighting governments and banks, crypto infrastructure starts serving them. And this brings us to the next layer of the story, blockchains themselves. Because once assets like treasuries are tokenised, the question becomes, where do they live? And this is where a lot of people get confused. They want to know which chain will win, which token will benefit, which ecosystem will capture value. But that's not quite the right framing. The future that's emerging isn't one chain replacing everything, it's a layered system. You have issuance layers where assets are created, governed, and regulated, and you have distribution layers where assets move, trade, and are used. Institutions care deeply about issuance layers. They want legal certainty, compliance, predictable fees, reliability over decades. That's why most early tokenised treasury products cluster around environments institutions already trust, not because they're decentralised, but because they're dependable. Once issued, though, assets don't stay put, they flow. They get used as collateral, they get integrated into platforms, and they move to where liquidity is. So instead of a single winning chain, you end up with a small number of heavyweight issuance anchors, a broader distribution across multiple rails. That's not chaos, that's finance. And it mirrors how traditional systems already work, just faster and more transparent. Now let's zoom back to the global picture. Because tokenised treasuries don't just solve a US problem, they slot neatly into the same global split we talked about in part 1. China chose no private stablecoins, no open yield, state-controlled tokenisation only. The West is choosing regulated private issuance, stablecoins for payments, tokenised assets for yield. And then emerging markets sit somewhere in between. And this matters because in countries with weaker currencies, fragile banking systems, capital control, stablecoins became popular out of necessity. But yield layered on top accelerates capital flight. Tokenised treasuries offer an alternative. Still dollar linked, still yield bearing, but easier to fence into regulated access points. That's why this model is spreading quietly. Not because it's revolutionary, but because it's compatible. And that compatibility is the theme of this entire cycle. Crypto doesn't win by replacing everything. It wins by becoming unavoidable infrastructure. Which brings us to the uncomfortable realisation. A lot of people are waiting for the next big crypto narrative. They're watching memes, they're watching influencers, they're waiting for hype. But the real shift is happening somewhere far less dramatic. In balance sheets, in settlement rails, in how yield quietly moves on chain without triggering political alarms. And that's why part 1 and part 2 matter together. Part 1 explains why stablecoins crossed a line, why yield triggered pushback, why regulation accelerated. Part 2 explains how the market adapted, where yield actually went, and what kind of crypto future regulators are willing to live with. This isn't the end of innovation, it's the start of a different phase, one where speculation matters less, infrastructure matters more, and understanding structure becomes a real advantage. So the next time you hear someone say governments are killing crypto, ask a better question. Which parts are they fencing in? And which parts are they quietly enabling? Because the answer to that tells you far more about the future than any headline ever will. Before you go, if this video helped connect the dots for you, let me know. Hit like if it added value, subscribe if you want more content like this, and drop a comment below. Do you think tokenisation is crypto being absorbed into the system, or crypto quietly reshaping it? And as always, if you want to go deeper into these conversations every week, join me and Milkshake Matty on the UK Crypto Podcast. You can catch all the episodes right here on YouTube and also on Spotify. Thank you so much for watching, and I'll see you in the next one.